Hello and welcome to the latest episode of On the Money, a weekly look how to get the best out of your savings and investments. When we started the podcast nearly 2 years ago, we wanted to ensure that you, the listener, would have a big say on the investment topics and trends that we cover. And over that period, I've had lots of people email in and come up with ideas, which has been a big help in shaping the show. Thank you for those of you that have been in touch. I'd love to hear from more listeners, and the best way to get in contact is to email otm@ii.co.uk. Please let us know what topics you'd like us to cover in future episodes, which questions you'd like me to answer in our future question and answer episodes, and also if you have any ideas about who you'd like me to interview, then I'm all ears. Please do send in your suggestions. In this episode, we're tackling questions that have been submitted in by listeners. We last did a question and answer episode in early May, so I thought the next one was overdue. As I did last time, I'm going to cover off questions that are more related to funds, and then I'll, in the second half of the show, be bringing in a guest, Lee Wild, Head of Equity Strategy at Interact Investor, to answer questions that are more related to the stock market and individual companies. So first off, I was asked, why do funds not make clear when they have tobacco holdings? The person who got in touch didn't want to be named, but he got in touch following an interview I carried out with a fund manager who has tobacco holdings, but they're not in the top 10 holdings. So unless you do further due diligence and try and find the full list of holdings, which this listener did, then you wouldn't necessarily know by just looking at the fund fact sheet. So tobacco is off limits for some investors, and I completely get it. And when it comes to funds, I do often see a UK equity income fund hold British American Tobacco or Imperial Brands, or more often than not, they're investing in both of those companies. The main reasons over the years why fund managers have said to me why they hold tobacco stocks is because they have defensive characteristics, such as pricing power, and they have high yields that are generally dependable. So there's among the main reasons why those two stocks are popular with UK fund managers with an income mandate. I completely take your point of the challenges of knowing whether or not a fund manager is investing in tobacco. In terms of when you're looking on the fund fact sheet, you can look at there's a breakdown of sector exposure, but as tobacco is part of the consumer staples sector, you're not necessarily going to see a breakdown of tobacco within that sector. And if tobacco stocks are not in the top 10 holdings, then you're not going to see them on the fund fact sheet either. One thing that may work, although it may not, is to simply Google the name of the fund and those two tobacco stocks to see if that brings up any information. If it's a well-known fund, there could be articles or video interviews that have been done in the past, which may then show whether or not the fund has tobacco. Some fund firms do publish all of their holdings. A small number do it monthly. It's more common to see a fund firm do it twice or once a year in an interim report. I try and track that down. However, do be aware that not all fund firms list all of their holdings even once a year. Failing that, I think the other option would be to directly ask the fund management company whether the fund that you're interested in has tobacco holdings or not. Next up is a request from Derek, who very kindly said he finds the podcast really informative. He asked, would it be possible to cover the use of ETFs in a portfolio? Derek pointed out that generally there is a lot of focus on funds and investment trusts, but less so on ETFs or index funds. And he added whether I could explain the structure of ETFs, such as what equally weighted means. Well, Derek, I'm always very happy to try and explain things in a straightforward and non-jargon manner. So I'll try my best with this one. So I think the first place to start is to very briefly explain the differences between active funds and passive funds. So an actively managed fund, it's managed by a professional investor, and they invest in a basket of investments with the aim of outperforming a comparable index. So let's say it's a UK fund. The fund manager may pick 50 to 60 of their best ideas, and they're hoping to beat a comparable index, such as the FTSE All-Share Index, which owns around 600 shares. When you buy an actively managed fund, you're hoping that that active fund will outperform the stock market. However, there are no guarantees that that will happen. Passively managed funds, which are structured as either index funds or ETFs, which stands for exchange traded funds, they mirror the up and down movements of an index. So it may be a passive fund is mirroring the performance of the FTSE All-Share Index. So it is tracking those 600 companies that are in that index, and it is aiming to provide the same level of return as that index minus its fee. So let's move on to what an ETF is in a bit more detail. So as mentioned, they are a way of tracking a broad basket of stocks, such as the FTSE All-Share or the S&P 500, for example. However, there are other types of indices that ETFs also gain exposure to. The other asset classes that you can buy an ETF in are bonds, property, currencies, commodities such as gold and oil. And ETFs can also track the up and down movements of a more niche basket of stocks, such as certain themes like cloud computing, or to track a basket of companies that have certain qualities or characteristics. For example, there are some ETFs that track the up and down movements of companies that have consistently raised their dividends over a certain time frame. As I briefly mentioned, passive funds, they come in two forms: index funds or exchange traded funds, ETFs. The core difference is that unlike index funds, ETFs can be traded throughout the day on the stock market, much like individual stocks. However, in my view, if you're a long-term investor, the difference is not important. The main advantages of index funds and ETFs is that they are low cost, generally, and another attraction is in their simplicity. If you're buying an index fund or an ETF, then you're opting to simply buy the market, and you're going to see returns mirror how that index performs, minus in most cases, the small fee that the passive fund charges. The main disadvantage is that by design, an index fund or an ETF, it's not going to give you outperformance. Actively managed funds aim to give you this. However, there are no guarantees that outperformance will be achieved. So I've hopefully covered off the basics there. Now, in terms of other important things to know, so Derek asks what equal weighted means. So before I get to that, most index funds and ETFs are market cap weighted, ranking companies by their size and share price success. This is because this is how most stock market indices operate, such as the FTSE 100 and the S&P 500 index. So investors buying an ETF tracking a specific index, such as the FTSE 100, would expect to gain exposure to each company in that index in proportion to how it appears in the index. So if Shell is 5% weighting in the FTSE 100, then you'd expect a FTSE 100 index fund or ETF to have 5% exposure to Shell. So an equally weighted index is a less common approach for index funds and ETFs. But under this approach, each member of the index accounts for the same percentage. So if it's an index of 100 stocks, then each stock will receive a 1% weighting. Now, one of the main benefits of equally weighted is that investors are avoiding being overexposed to stocks that have potentially become overvalued, or worse still, potentially part of a bubble. So as mentioned, if you're looking for an equally weighted ETF, there is less choice. It is more common for an index fund or an ETF to track a index that is market cap weighted, mainly because that is, as I mentioned, how most stock market indices operate. Now, there's so much more I could cover, but I'm just going to mention other things to look out for when researching ETFs, and that is to check out whether the ETF is providing physical or synthetic exposure. So a physical ETF, it buys the shares of the underlying index that it is aiming to mirror, whereas a synthetic ETF, they do not own any of the shares in the index they follow, and instead of buying the shares, they use a financial institution that essentially buys the shares for them, and then that financial institution is then obliged to deliver the index return. There's a lot more jargon related to ETFs that I could also cover off, but in the interest of time, I'll leave it at there for the moment, and I hope that was helpful, Derek. Moving on to the next question, which is also related to index funds or ETFs. Amelia got in touch to say that she found one of our recent episodes very useful. And that episode was when we examined whether Scottish Mortgage, Fundsmith Equity and Lindsell Train UK Equity would return to form. And we explained why that trio had been facing a tough time of late in terms of performance, particularly over the past 3 years. She mentioned that she's considering adding some index funds to her portfolio and asked how to figure out which ones are best. So for me, the main things to look for are the charge, so the yearly fee. I think when it comes to passive funds, index funds or ETFs, you want to buy one that is low cost as possible. If there's two index funds that are tracking the same index and one has a much higher fee than the other, then why would you pay more for essentially the same product? I'd also check out tracking error. So this should be on the fund fact sheet. So what tracking error does, it measures the consistency of a portfolio's tracking difference over time. Now, without getting into too much technical detail, what it essentially does is it calculates how often and how wide the performance of the portfolio deviates from the index. So a small tracking error, it indicates that an ETF will follow its benchmark very closely, whereas a large tracking error indicates the opposite. So what you want to see is the lower the percentage figure, the better. And I'd also take a look under the bonnet to see which index the index fund or ETF is tracking. So in the case of global index funds, for example, some index funds and ETFs, they just stick to developed markets, while others have some exposure to emerging markets. And in the case of global equity income ETFs, some filter for shares with high dividend growth, others will focus on high yields, while another approach is to apply a quality screen to try and avoid shares that will potentially cut their dividends. So they're the main things I'd look out for when researching ETFs or index funds. Cost, tracking error, make sure that you're happy with the index that is being chosen by the provider. And just to give a few examples, and please do bear in mind, this is not financial advice. In terms of global passive options, we have on Interactive Investor Super 60 list the iShares Core MSCI World ETF. It provides exposure to around 1,500 shares from developed markets and costs 0.2% a year. But there are other options, so do check them out. One of those options is Fidelity Index World, which has a lower fee of 0.12%. This also just tracks developed markets. So if you're looking for a global ETF that has some emerging market exposure, then you'd have to look elsewhere. One option is Vanguard FTSE or World ETF, and another is iShares MSCI All Country World Index ETF. And the final question I'm going to cover off before I'm joined by Lee Wild is a question from David, who asks, what would be a good holding to complement his position in Vanguard LifeStrategy 60% equity? I'm sure most of our listeners will be familiar with the Vanguard LifeStrategy range, but for those not in the know, this is a range of 5 funds that invest in other index funds that are managed by Vanguard with varying exposure to equities. There's a 20%, 40%, 60%, 80% and 100% version, with the remaining balance in bonds. Now, as mentioned, this is not financial advice, but what I would say for information purposes is the Vanguard LifeStrategy 6% equity, it is widely considered to be a core holdings. So core holdings are those that you can in theory invest in for the long term, as they shouldn't give you any nasty surprises. So as you have a core holding, I'd be looking for a smaller satellite holding that will potentially add something different to the portfolio. The trade-off with a satellite fund is that they are higher risk in pursuit of potentially higher rewards, which is why satellite holdings should have a lower percentage in your portfolio versus a core holding. For a satellite part of the portfolio, among the options to consider would be things like UK smaller companies or emerging markets. And the potential added benefit of examining those two sectors is that you're not getting much exposure to those areas with your current holding, Vanguard LifeStrategy 6% equity. So those two sectors will be giving you something different from your core holding, and you won't be doubling up your exposure. For the second half of the podcast, I'm joined by Lee Wild, Head of Equity Strategy at Interactive Investor, to answer the more stock market related questions that you submitted. So Charles wrote in to ask, Kyle, you've had a couple of UK fund managers on the podcast lately talking up the prospects for the UK stock market, particularly UK smaller companies. Could you share some data on which UK smaller companies shares are proving most popular with interactive investor customers so far in 2024? So Lee, I'll pass the baton to you on this one.
Thanks, Kyle. Well, look, I've picked out a handful of small caps that have been popular so far this year. And across all of them, really, I mean, investors are either interested in the growth potential, obviously, recovery potential, so companies that have fallen back sharply and could do better, or investors are happy to play volatility, which we're seeing with many of these share prices. Now, the first one, and easily the most bought small cap on the II platform this year, so far is Helium One Global. Now, it's currently a £70 million company. It raised money for a drilling program for helium in Tanzania. Shares rocketed from 0.2p to 3.7p. They've since dropped back a little, but investors are awaiting news flow there. It's a company called Avacta, which was heavily backed earlier this year when the share price slumped more than 40%. So in late February, it's a cancer treatment specialist. It confirmed a fundraising at about 50p a share, which was a 34% discount to the previous day's closing price. Now the share price has almost doubled following an AGM update at the end of June. Investors did well there. Only 5 years ago, Petrofac, company listeners might be familiar with, was a £2 billion business. Now it's less than 100 million and trading at around 15p a share. But investors are back in a recovery. And again, it's historically a volatile share and investors are exploiting that, I think. So watch that space. There's also a couple of companies that have grabbed headlines more recently. There's an oil company, Petro Energy, currently capitalized at about 10 million. Now it's been popular after it signed a very significant and transformative deal, their words, not mine, with an energy trading business. Now the chief executive has been super bullish. The share price jumped from 0.55 pence to a peak of 12.4p in quick time. That's a gain of more than 2,000% in just a couple of weeks. There's £16 million Upland Resources as well, which has attracted attention. Last summer, the share price jumped from just over half a penny to more than 5p, following what it called significant progress at an oil field in East Malaysia. It was well above 4p as recently as April, but has since fallen to a low of 0.9p. So the company said that the state-owned oil company Petros had put the oil field out for competitive bidding. Now that upset Upland, which had been working with Petros for months on an exclusivity deal. So we're waiting for further news there.
Thanks, Lee. Now the next question that came in from Belinda, I think this may have came in after National Grid announced its rights issue, because Belinda wrote in to ask, what is a rights issue and why do companies do them?
A rights issue is a way for a company to raise money by issuing new shares. Now, it's normally the choice when companies need to raise a lot of money, in excess of what they might be able to raise just from institutional investors. So shareholders are offered the new shares in proportion to their existing holding, normally at a big discount to the current market price to reflect the risk involved. The riskier the issue is perceived to be, the bigger the discount. Now, I mean, you're only going to have a rights issue if the company needs to raise money for normally because it's in a little bit of trouble. So shareholders who do not take up their rights can sell them, but their stake after the rights issue will be diluted, as there'll be many more shares than there were before. So recent examples include Rolls-Royce and National Grid, both of which prove it's not always a bad thing. So Rolls-Royce, that ran into trouble during the pandemic. Obviously, the aviation industry was crippled. That's where Rolls makes a lot of its money. So it decided to raise £2 billion. But we've seen, since the new CEO took over, a spectacular recovery, and it's rewarded shareholders who took part in that rights issue. The shares are at a record high. And similarly with National Grid, it's just got away the UK's biggest rights issue since 2009. It was £7 billion. So it needed the money to deliver a massive investment program in the energy network infrastructure over the next 5 years. Again, shareholders who took part in the rights issue have been rewarded with a much higher share price.
And the final question we're going to cover in this episode was from Stephen. He wrote in to say the II app is great at notifying when there's an AGM vote and that he always votes. So They're both great things to hear. We've been on a mission the past couple of years to try and encourage more and more of our customers to exercise their votes. However, he mentioned that some of the voting proposals he doesn't really have much of an idea about, particularly, and I'm glad that you're answering this one rather than myself, Lee, is the option to renew the authority for disapplication of statutory pre-exemption rights. Should we start off with that one, and then do you mind covering off some of the other key voting items that our listeners will see when they do vote?
Yeah, of course. As you say, Carl, I mean, II has been a keen advocate of shareholder participation at AGMs for a number of years, and more customers than ever are having their voices heard. So we've made the ability to vote online a default option for all customers rather than having to opt in. So that's a big positive there. But to start off, I mean, there's lots of more straightforward votes on the at AGMs, but we'll start with preemptive rights. So preemptive rights enable existing shareholders of a company to buy the company's shares before they're offered externally. So that means existing shareholders can maintain their proportional ownership, help safeguard and prevent excessive dilution, and give shareholders some control over potential new investors. But companies might want the authority to disapply preemption rights via special resolution, requires 75% approval when they want to raise money from external parties. So that means existing shareholders won't be offered shares, for example, when raising new money through placings or share offers.
And in terms of the other key voting items that you would typically see, what are they, and could you run through some of them?
Yeah, I mean, it's the remuneration report. Investors or shareholders will get the right to opportunity to vote on. Shareholders might feel boardroom pay and bonuses don't adequately reflect the performance of a company over the past year. So while it won't change what's already been paid, if enough votes go against the report, and historically we have seen that happen, quite a lot of companies have had a big sort of vote go against the remuneration report. There is an obligation under good governance for companies to understand the cause of the discontent and possibly take action on future pay awards. There's a remuneration policy. I mean, that's more around the framework for salary bonus and LTIPs, these long-term incentive plans. So there's usually plenty of consultation in advance to take on board the views of major shareholders around that policy. You've got the election of directors. Now, it all looks fairly straightforward when you see these votes, but often it requires a bit of digging around. The companies won't say why they should be elected. You'll have a list of names and you'll have to do a bit of digging around yourself, unfortunately. So this is non-executive and executive board members. I mean, they retire, then offer themselves for re-election, and those who joined the board in the period during the last AGM stand for election. So they're not always a formality, these votes. But serving too long on a board is another issue, because investors are seen as losing their independence, that kind of thing. But so that's election of directors. You'll also see dividend declarations. So this is where shareholders believe a company doesn't have the resources to fund a dividend. They might trigger a vote against that resolution, but as you'd expect, that's pretty rare. Political donations, I think, as mentioned in one of the questions, so you'll get a chance to vote on that. But the main ones that crop up, that's outside of special resolutions, and you might see those on climate change policy, that sort of thing. You saw that with BP and Shell over the past few years.
And editorially, one of our freelance contributors, Graham Evans, he also does a lot of digging around. And if he spots something that is potentially contentious, we cover it, don't we, editorially? Yeah,
normally during AGM seasons, or normally ahead of AGM season, so we're ahead of the game, we'll publish editorial every Friday. We haven't done so far because we've covered a lot of the AGMs previously, but typically we'll have an AGM alert published on a Friday, which will cover some of the big company votes in the month ahead.
My thanks to everyone who submitted in a question and to Lee. And thank you for listening to this episode of On the Money. If you enjoyed it, please follow the show in your podcast app and do tell a friend about it. And if you get a chance, do leave us a review or a rating in your podcast app too. You can join the conversation, ask questions and tell us what you'd like to talk about via email on otm@ii.co.uk. And in the meantime, you can find more information and practical pointers on how to get the most out of your investments on the Interactive Investor website, which is ii.co.uk. And I'll see you next week.